let's just kind of get into it. If you attended the last webinar on the Gray Fund, we touched on some of these topics. I wanted to really kind of distill down some of the kind of issues we're seeing in the market, how we're mitigating some of those issues and risks, and really setting ourselves up for success. Because at Gray Capital, we've taken a little bit of I would say greatly different posture. As the markets have significantly changed over the last several weeks and really month. We're just in a completely different environment than we were a few months ago. Demand for multifamily apartments is still at an all-time high. We saw year-over-year rent growth coming in last month, breaking records at 15% year-over-year nationally. Occupancies are at an all-time high. So that's all great news for multifamily, not to mention the incredible supply and demand imbalance that is still in the market. However, we got a lot of other things are going on, not to mention, a war in Ukraine and interest rates rising significantly, especially that 10-year treasury that I was hitting up at 2.7%, I believe, yesterday on Friday. So these are factors that we really need to closely pay attention to. And the strategies that made a lot of sense and were the appropriate strategies last year, I don't think are the right way to look at acquiring multifamily apartments, especially in the way that you're going to finance those assets. You have to be much more careful than you were 6 months ago. And at Gray Capital, we're very much in tuned to the changes in the markets. We're staying up on top of the market every single day. You can subscribe to the Gray Capital YouTube channel to see our weekly Gray Report episodes. We're breaking down all the new market trends, research reports. So if you want to go over to YouTube and search Gray Capital, we will pop right up. Make sure you subscribe to that as well. All right, let's just get started and get into it. First, like I was just mentioning, I want to mention some of the risks revolving interest rates in 2022, and then I want to get into the first project that we have under contract for the Gray Fund. And then again, anytime you'd like to ask a question, you can just pop that right into the chat feature, and I'll get to it as soon as possible. Again, you can go to gray.fund to learn more. You can go to graycapitalllc.com. We have our investor portal. If you want to just sign up for the Gray Fund right away, you don't technically have to talk to anybody. You can just go on, create a profile, and invest today if you would like. The Gray Fund does feature a dual class structure that allows investors to combine two different classes of equity to create a tailored risk and return profile. Really, it allows you to really create an investment that is tailored to your needs and goals, that is backed by solid, stable, cash flowing multifamily assets and a diversified portfolio of 7 to 10 properties. But again, let's look at these risks. There's a lot of uncertainty in the market. I think if right now, if we could call this time, we could label this time period to be, uncertain. Not only do we have a war in Europe, we've got politics, coronavirus that keeps popping up and down. Interest rates moving, we're just in new economic times in general, and very few people know where it's going. And I think that requires us to take kind of the proper steps and precautions to tailor the most appropriate investment that will give us an appropriate balance between risk and return. Because I believe that there is the risk profile today is not the same as it was. We're looking at some nonlinear and exponential risk if you structure a deal in a certain way, and if you're exposed to interest rate volatility right now. We don't know where interest rates are going to go. If we look at the Fed dot plot, what they've been communicating, they're saying that the Fed funds rate, and which is SOFR, the secured overnight financing rates, a lot of variable rate multifamily loans are based on. It could go all the way up as high as 3%, anywhere between 1.7 and 3%, which would significantly change a return profile if you had no interest rate hedge and you hadn't mitigated that risk. And a lot of apartment operators over the last couple of years have been comfortable in a low and lowering interest rate environment, but the winds have changed direction. I think uncertainty creates opportunity, however, because with this uncertainty, like I said, apartments are still seeing record demand. Inflation will still be a driver of rents, and the way that owning a home is incredibly much more unaffordable than it ever was today is just creating a larger pool of renters. And I think targeting, really kind of these B class kind of median demographic investment strategies makes a lot of sense in today's market. And that's what we've been pursuing at the Gray Fund. So we can just say it's a risky market and not do anything, but I think it's more appropriate to really just quantify the risks, mitigate and adapt to the current market to take advantage of the solid fundamentals in multifamily housing. But let's look at the Fed tightening in this interest rate shock that has markets and real estate investors, worried. Berkadia did a really interesting study. It was several months ago. I interviewed Noah Stone, one of the authors on the piece on the Gray Report, a little over a month and a half ago, kind of really digging into looking at the past in similar events. And I would say no past events are really the same of what we're dealing with today, but it gives us a little bit of information of how multifamily apartments performed in, I would say, somewhat similar environments. But then after that, I want to look at what are the actual steps that we can take and Gray Capital is taking in order to mitigate these risks. So the conclusions of Berkadia is really that, major changes in monetary policy take about 5 to 6 quarters to affect leveraged apartment returns. Now, again, the timeframes post-COVID have certainly been compressed, but real estate in general is quite a bit of a lagging indicator. And we don't believe that we're going to have, an immediate shock to a multifamily. Now, that being said, we are seeing some softening in the market, but really kind of a healthy transition from instead of seeing apartments trade significantly above their kind of asking price, which was kind of historically not normal. We're seeing properties still trading for what they're asking for, but not necessarily, again, 5-10% over what they had been trading for. I mean, a lot of this has to do with just rising interest rates and not being able to get the financing and the high leverage that many apartment operators are looking for. Another conclusion that Berkadia made that in eras of kind of stagflation and quasi-stagflation, apartment returns actually outperformed most other asset classes. Now, stagflation is essentially when we have kind of lower GDP growth, but we have some kind of low GDP growth and high inflation, or high unemployment and high inflation. Now, we don't have high unemployment. In fact, we have record low unemployment right now, especially in the markets that we're targeting, like Indianapolis. I think December we were at 1.2% unemployment. But the concern is that if growth all of a sudden really slows down, which I don't necessarily think it's going to, but if growth immediately slows down and we still have high inflation, that creates a little bit of a perilous situation. But looking back at the past and quite a few quasi-stagflation scenarios and periods of time, apartments still performed really well compared to other asset classes. And even in a rising interest rates environment, and even in taper tantrums where the Federal Reserve is unwinding its balance sheet, apartment returns still kept up and again outperformed. So again, this is from Berkadia. Looking at apartment returns in an inflationary environment, apartments again track inflation, especially if you have a large portfolio like the Gray Fund. We're tracking inflation on a daily basis because we're signing new leases on a daily basis. As prices go up, we can reset our prices at a very, very high frequency, and even a higher frequency than most other commercial real estate asset classes. Then also looking at kind of the 10-year treasury and the correlation to returns in apartments, because a lot of people look at, the 10-year treasury because so many loans, especially fixed rate financing, and just it's one of the key indicators for the kind of the cost of capital, your financing rates. How does that relate to apartment returns? Many people would look at the difference between the 10-year treasury and current cap rates, looking at what that spread is. But when we actually take a closer look, there's not as much of a correlation directly between the 10-year treasury and apartment returns. Again, it's this lower right graph, and it's a little bit all over the place. There's not a direct correlation. Where you could get in trouble is if you're buying at a cap rate that is just way too low, and we've seen cap rates just plummet. I mean, sub 4, even like in high 2s, incredibly low cap rates. And, again, the 10-year treasury, 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 10 if you're buying at a high interest rate, you're going to have very little cash flow that first year. So again, there's a different risk profile currently in the market related to financing driven by, monetary policy unrelated to housing demand. And so how do we take advantage of the incredible demand for apartments while not getting tripped up by, monetary policy and interest rates? Again, this is looking at apartment returns during the last time the Fed tapered their balance sheet, which they are getting ready to do. There was not much difference in returns during that period, although we certainly want to watch as the Fed attempts to unload quite a bit of their balance sheet and holdings of mortgage-backed securities. I think they're going to be relatively slow to do that, at least on the MBS side, probably not selling more, just letting those bonds burn off. And then looking at how apartments performed compared to other asset classes in, again, these quasi-stagflation environments. Apartments really outperformed, especially even looking at the stock market, looking at the Wilshire 5000 and the NASDAQ, that was actually negative. Apartments outperformed those other two asset classes. So what can we do? Because again, there's an incredible opportunity with the demand for multifamily apartments. But how do we not get tripped up by these rising interest rates? So we're doing a couple things here at Great Capital. We're looking more at fixed rate debt rather than floating rate loans or bridge loans. If we would use a floating rate loan, we are buying a cap or using some kind of hedging instrument to limit the amount of interest that we could pay. But we're also, I think it's important to watch organic growth. Now that's just basically make sure that we're not over speculating, because I think one big pitfall that many investors could be making right now is over speculating the length that we will see incredible rent growth. Again, we're still seeing a lot of strong rent growth, but some lofty projections in multiple years down the road could really affect the overall return. And it's important not to over speculate. Looking at what's happening, what has happened, there is a big difference between market rates and effective rates right now, rental rates, and most of that will be absorbed over time. But after that, we don't, predicting rent growth in 3 years is very challenging, and it's really not something that you want to be building a business plan around. You want to look at what's happened and what's happening right now. So we've got a project under contract at the Gray Fund. It's a very hard environment to place projects, to win them, to find opportunities. This is an off-market opportunity, but this is not just kind of fall into our lap. This was the result of over about a year and a half's work of communicating with an owner and actually going through a broker. So it did come through a broker, but we went direct, knowing that this owner had several properties in markets that we were interested in, making a connection through the broker to maintain our broker relationships. And this project was then brought directly to us. We then, put it under LOI, have been negotiating the contract, and we signed that contract yesterday. So let's take a look. So the property is called Club Meridian, and let me just move my my thumbnail out of the way so you can actually see what I'm talking about here. 406 units in Lansing, Michigan. Now it's in the Lansing MSA. It's actually in Okemos, Michigan, which is a suburb of Lansing on the southeast side of the city. Again, but it's its own town, Okemos. It's very suburban, and the property itself is beautiful, and there's a great business plan, but we're very data driven and very focused on demographics. And the demographics in the market of Okemos are really everything that one would want when you're looking at a market to invest in for apartments. There's a couple of reasons why we like it. One, it's high incomes. We're going to look at the median household income. It's between 90 and 100,000. And the closer you get to the property, actually the demographics get better. Strong population growth over the last 5 years. It was growing at over 1%, 1.4% every single year. Projected strong population growth over the next 5 years. Great household growth, great jobs in the area. It's near Michigan State University, but not very many students live there. Corporate headquarters is right around the corner. Medical offices that provide great jobs are right in the area. So it's really kind of kicking on all the cylinders that we want to see, not to mention really not that much supply coming into the market. There's one project that they're building in just really the entire area. It's about 110 units. And when those units are delivered, they're going to have significantly higher rents. And we'll see that compared to some of the other newly built construction, how Club Meridian, which is the property, again, 406 units up in Okemos, Michigan, submarket of Lansing. We love this property because it has minimal physical obsolescence, which means that it doesn't look like an old property. It doesn't have like the bones that you can't make it into something else. It's very attractive unit layouts, floor plans. The architecture is still relatively modern. It doesn't look incredibly dated. They're still building apartments like this today. So again, it doesn't look that dated. Here's just another picture, looking at the blue skies. It's got a brick siding as well as vinyl siding. The current owner has put quite a bit of capital into this project over the past several years. They bought it back in 2016. A lot of the money was put into the exteriors and really kind of continuing to maintain the asset. So they've put a lot of money in many of the right places. They've only recently started to do interior renovations, and they are getting really great rent premiums all the way up to $200 by just $3,500 per unit renovations. Now we're budgeting a little bit more than that, but essentially continuing what they've already proven out over a small percentage of the property. We are going to continue to roll that out throughout the property, get into the specific details in a minute. But another indication of demand is when we were up there touring just several weeks ago, renewal rates, the amount that rent is increased on existing residents, which usually isn't that much, very large. They're increasing renewal rates by 10%, and new leases are being increased by 15%. And that's just organic without really any renovation at all. That's just indicating the demand for the property itself. So looking a little at the details of the investment summary, some of the project details, property details, it's a relatively big deal. $77 million purchase price. Again, 406 units. It was built in 1989. Solid B plus class property. It's a stabilized property, 96.5% right now. It's basically sits between 95 and 97% over the last decade. And we'll look at that, but indicated a long history of strong demand. We're purchasing it right around $189,000 per unit, which is below current replacement costs. And we're looking at this for a relatively long-term hold, up to 10 years. Now, one of the reasons that we're looking at a 10-year hold as compared to like a shorter 5-year hold is the uncertainty in the market right now. There's a good chance that we will sell this asset prior to 10 years. And even a better chance that we'll refinance within the first 5 years. But with the market conditions as they are today, we did not feel that it was appropriate to bake in a refinance, not knowing what interest rates are going to look like in the next couple of years. But we believe that we will certainly be able to refinance this property in a couple of years and return quite a bit of cash. And we'll get to this also in a second, but we're using lower leverage on this acquisition. We're finalizing our debt terms as we speak, but right now we're looking anywhere between 55% and 65% loan to value. That is much lower leverage than a typical acquisition, even at Great Capital, and where we are typically using leverage around kind of about 75% loan to value or 70% loan to cost. And have even done projects up to 80% loan to value. So quite a bit lower leverage, 55 to 65% LTV. And so that means the returns are going to be perceived to be a little bit lower than if we were using higher leverage. And also if we were using a shorter hold period, because if you compress the hold period, your IRR increases because it's a measurement of time as well. We're looking at placing a fixed rate agency debt on the property itself with up to 5 years of interest only. And again, that will just really set up the project, lock in an interest rate at acquisition, completely eliminating and removing interest rate risk for the investment for the duration of the project, but still with the opportunity to add a supplemental loan that agency loans allow for, to be able to pull cash out once we force appreciation by adding value and increasing rents at the property itself. A lot of great amenities at the property. There's a pool, tennis court, there's a health club with a sauna, renovated clubhouse. The previous owner did a great job renovating the current clubhouse. Playground. We're also going to be adding a dog park. It needs a dog park. There's washers and dryers in every single unit. The roofs have been replaced recently. And overall, the property shows incredibly well. We were there a couple of weeks ago, like I mentioned. We'll be back shortly as well to conduct further due diligence. And the property, again, it just shows really, really well. It's an attractive asset. Just wanted to show kind of where the property is in relation to the rest of Lansing. See right around here, let me put my little cursor on. As you can see, Club Meridian is right here in Okemos. Okemos is a very suburban location. The headquarters to Delta Dental is right here. It says several hundred high-paying jobs. Quite a few of those individuals and employees live at Club Meridian. MSU, Michigan State University's campus, is not that far away also. This blue area over here is Michigan State University. And then down below are these research facilities. They look like just, cornfields, but there's actually a lot of kind of advanced research facilities that, employ quite a bit of MSU faculty and are literally right down the road from Club Meridian itself. Also, literally next door to Club Meridian are all these medical offices. It's a really nice medical office complex. We love medical offices, again, kind of right at the income demographics that we'd like to see. And then, if you go further up the road, you're getting all the kind of the, retail, shopping, restaurants, everything that you would want just up the road here. There's a Meridian Mall is right here. We've got our Whole Foods right down the street, Meijer, Home Depot, there's a Target, all the shopping that you might that a resident would want to see. There's also great access. We've got 96. You can't see it just below this map, but just south of Club Meridian, 496 over here to the west. So really well positioned in terms of kind of just being geographically located. Some of the highlights, some of the reasons why we really like this project. Again, meds and eds. The MSU is a driver, consistent employment base, strong submarket growth. 3.2% forecasted population growth over the next several years. Proven rent growth. As I said, current lease renewals be increased by 10%, $150 to $200 premiums on renovated units. And it's had a high historic occupancy, which we'll look at a chart here provided by CoStar to look at its occupancy over the last 10 years, but really just solid demand over time. High income area. This can't be understated enough. And we've seen great success with previous great capital projects when we have had just the right income demographics. It just allows us to move rents more than if we were really limited and there's a ceiling on what we could do. 92,000 median household income within 1 mile. That's not like a market down the road. That's right where these apartments are. 92,000 for median income. That means that if we looked at just the 30% rule of what someone could pay in rent for housing, they could pay up to $3,000 a month. Just about. Now we're nowhere near that. We're just about a third, a little over a third of that. So the income demographics show there's a lot of room for growth. Again, and I think there's not going to be a slowdown in the preference for people to live in the suburbs. So a lot of great suburban momentum, which is a consistent theme for the Gray Fund itself. Again, some of the strategies, preserving principle, just maybe start, preserving principle, creating an investment that has a high probability of return, but low probability of loss. Now, certainly there's always the chance of loss. This is an investment. There's always risk involved, but in order to mitigate as much risk as possible is, a major priority. It's a stabilized asset, cash flow out of the gate, good cash flow out of the gate. We're getting, attractive financing, but a relatively higher cap rate than you're going to see, especially in markets in the Sun Belt. But we've got strong population growth. So it's an inefficient market. Investors aren't focused on the Midwest. They don't understand it. We're based out of the Midwest. We do understand it. There's a already proven plan to be able to move rents closer to the market, organically and through forcing appreciation through a targeted renovation plan. Strong employment in the market that we're going to take advantage of, and we always find opportunity to add operational efficiencies and run assets just a little bit more efficient, using technology, virtual leasing, and things that some of the industry is doing, but not everyone in the industry is currently doing. We're going to be delivering, targeting average cash flow a little bit over 8% over the hold period. Continue to elevate the brand of Club Meridian in the market itself, and we're going to be shooting for an IRR of at least 15%. And as I said previously, we will be looking to refinance this asset in the first several years, especially since we're going to be using lower leverage. We're going to have quite a bit of equity to pull out of the project, but we were going to wait until we force appreciation, increase the value where interest rates are favorable for that refinance. But the business plan does not require a refinance. It's not really contemplated in our underwriting, because that would really manipulate the underwriting. We wanted to really look at a base case conservative view of what the project is going to look like over a 10-year conservative hold period. Looking at the unit mix, it's a mix between 1 bedrooms and 2 bedrooms. One bedroom, 1 bath make up about 30%. 2 bedroom, 2 baths make up about 27%. And then 2 bedroom, 2 baths make up 43%. Now there are a very small number. There are 2 3-bed units, very large, 2,000 square feet, 3 bedrooms. I believe these were actually originally some units that were combined at one point. So there's only 2 of those, but they do rent for quite a bit. Just look at a picture of some of the just an image of when we were over in Okemos, doing our initial tour several weeks ago. As you can see, they're really attractive floor plans. A lot of light, a lot of windows, nice living rooms, great kitchens. Even the kind of the classic units that haven't been renovated are still very attractive. And I think that's why they're still getting quite a bit of demand and able to increase rents, even without doing much. But they'll really are able to get a nice premium with a little bit of a lift in modernizing the units themselves. So this is kind of your typical classic unit at the property. I think these are slightly newer ovens and ranges and microwave, but kind of this is typically what you're going to see in a unit that has not been renovated. Still, it's really not that bad. It's a very attractive unit, but again, there's opportunities to make it a little bit better. Here's an example of an upgraded unit that they've done currently at the property. Again, they're putting in about $3,500 per unit to do this. LVT flooring in the kitchens and the bathrooms, Formica countertops, black appliances. 80% of the units have already had lighting upgrades, and about 40% have had plumbing fixture upgrades, but only about 20% of the units have had the full upgrades with the new appliances and the flooring. And again, those are 2 things that are relatively easy to do and that can be done in a quick turn time. If we were doing all the cabinets and everything, that would extend our turn times and our renovation times, which would increase vacancy and kind of just push the business plan out. But this is a very much more efficient value add strategy that will hit kind of our appropriate risk premium. And so we can do it at a faster pace than if we were doing a much larger renovation. It also kind of reduces that risk of, major supply chain issues. We've got the organic growth that kind of continued to support us, but we're not reliant on, every new component for the apartment to make the renovation plan work. The clubhouse, the current owners did a great job renovating the clubhouse. They modernized it, new flooring, new paints. It really looks like a brand new clubhouse. That's a very effective leasing tool. New fitness facility as well. They've got a sauna in here. It's not massive, but it's kind of the right size for the property itself. The pool, I think they've got a really attractive pool. The decking should be replaced. As you can see here, when we were there, it's just a little bit weathered. It's a little tired. I think we've budgeted to really just improve this, put a facade on there, to give it a little bit of a facelift. And you can see the fencing around there, just getting a little bit old, weathered. A lot of the signing around the property as well. It's similar kind of old wood siding. A lot of it's original. So we're going to be replacing that with new signage, replacing this fence with kind of a new, more modern, more like a wrought iron fence. Looking at our budget, the renovation budget, we're going to be putting in around a little over $2.25 million, just under that, a total of just under $6,000 per unit. That's about $4,000 on the interiors. We're going to be upgrading about 375. That's what we're budgeting for, at least. That's going to allow us to do new Formica countertops, appliances, finishes, which includes additional plumbing finishes or plumbing hardware, and then flooring in the kitchen and the bathrooms. And then on some first floor units, we will also do LVT throughout all the common areas besides the bedrooms. Now on the exterior, looking at painting the balconies. The balconies themselves are in good shape, but they need to paint. Again, about $50,000 for pool upgrades. Going to add a dog park, $25,000. We can do it for way less than that, but just being conservative. Some asphalt upgrades, $150. New entry doors, around $60,000, and new signage. We're estimating about $50,000. Again, that'll probably come in under, but just being safe. Let's look at, again, a little bit on the market, the demographics. Lansing, it's a state capital of Michigan, so there's a lot of just drivers and employment from being the state capital. Again, we've got MSU and quite a few corporate headquarters as well in the market. Okemos rent growth, it's growing around 10.5%. Very low vacancy, about 1.9%, comparable 4 and 5 star units. Average household income, $106,000. That's a very strong average household income. And the median income is also very strong, just obviously under the average, between the 80s and 90,000 range. And population growth between 2010 and 2022 was almost 13%. So very solid population growth. Again, just kind of looking at where Club Meridian is related to some of these job centers. Again, you can see it's quite suburban. Just again, digging into some of the demographics, populations, and households. Again, 2 mile radius. The 2010 to 2021 population growth rate is 1.6. Now, the future growth is lower than that, as you see in most markets around the country, but still just under 1%. And again, you see the demographics. The closer you get to the property, are more favorable. So look at the 2 mile, the 5 mile, and the 10 mile. The numbers get bigger the closer to the property itself. And even the bachelor's degree, or let's at educated residents, where 70% of the residents on the population in a 2 mile area, 70% have a bachelor's degree or higher. That's a relatively educated population that tends to pay the rent on time and has the incomes to support it. Looking at incomes now. Looking at incomes, again, average household income, 110, median household income, 86,000. And again, let's look at the 2 mile, 5 mile, and 10 mile and where we'd want to be. Right where this property is, or where the highest incomes are, it's where the most demand is. Again, 110,000 average income in the 2 mile versus 88,000 for the 5 mile, 74,000 for the 10 mile. Now, those are all solid income levels. A lot of other markets, you're closer to 50, 60,000. So even 10 miles away, looking at 74,000 on average, 53 on medium, that's still pretty good. But again, location, the closer we get to the property, the better the demographics get. And that's just one of the reasons what really attracted us to this market in the first place. And you can see kind of this household income by age as well, because, target, renter age is kind of mid-20s to kind of mid-30s. That age is bumping up as so many millennials can't afford to buy a home, but we've got solid incomes kind of in that range, anywhere between 60,000, even from 25-year-olds to 34-year-olds. And then that 30 to 40 category, very, very solid incomes. And you're going to have some baby boomers and older individuals as well that are going to be renting here as well. And that's where we see really high incomes. Further evidence, anecdotally, but on site, these are just, I don't know if you can see the kind of the rear tags there, but there were quite a few. Just looking at the cars, when we're on a property, I just like to see what kind of cars are parked in the parking lots around the apartment. a lot of Audis, BMWs, really nice vehicles. Again, some could be, certainly car poor, but again, it's just, you don't typically see a lot of Audis at apartments. And there's further evidence that the income demographics are where we want them to be. Again, population by age, there's a lot of renters, quite a few 25 to 34-year-olds. And that's exactly what we want to see. That is our target kind of renter age and just median renter age. Okay, so how does Club Meridian kind of shake up compared to the rest of the comps in the area? You can see it's a little bit below the middle of the pack. The kind of the best comp we believe is Central Park. It's the next bar graph of the gray Club Meridian. Just to the right is Central Park. This property is built right in like the same year, kind of late 80s, early 90s. We believe it was built by the same developer. They're getting higher rents than Club Meridian today. Most of their units are unrenovated as well. But then you can see what we're trying to do is take some of these newer properties that are right in the submarket that are charging, considerably more, $300 more. We're seeing if we can split that difference and get a nice rent premium while still being below kind of the current high-end A-class comps. Now, the 2 bedrooms make up the majority of the units, and this is where we're going to be able to get a lot of our rental premiums. You can see that just Club Meridian compared to Central Park, again, which we think is the best comp, is about $100 below, just organically. So we should be able to move rents $100 just by flipping a switch over time. But then compared to the other assets in the submarket, we are quite a bit below. I mean, Hannah Lofts is up at $1968 for the average 2-bedroom. Elevation is at $1872, and Club Meridian on average 2-bed rents is $1343. So we have quite a bit of room to move rents just organically, not even including our value add renovation plan. 3 beds, again, there's only 2 3-beds, so it's not that appropriate, but quite a bit of room. And again, our 3 beds are 2,000 square feet. At a 406 units, only 2 units, not going to move the needle at all, but we're still under market. Just looking at rent growth, again, just looking at some of the data. This is what's going on just today. I didn't put the forecast on here because CoStar, among most, don't really know how to predict rent growth in this market because they keep getting it wrong. Very, very solid rent growth in Lansing. This is just Lansing overall. And this is Lansing and Meridian Township, Okemos. I mean, you see just in general that Okemos, the submarket that Club Meridian is in, consistently outperforms Lansing as a whole. And you can see that it's really started to ramp up in 2021 and 2022. We're seeing over 10% year over year rent growth. And again, we're seeing kind of some of the highest rent growth right now, which is great because we've already locked in our purchase price. And as we're getting into peak leasing season, once we acquire the property, our average rents are probably going to be higher than what we're forecasting. So we're going to be starting the investment off in a high growth environment, but we locked our price in earlier, so we're not having to pay any more for the growth. It's just going to result in higher cash flow at the property. Again, so market rent per unit and rent growth, again, over 10%. This is I did include the forecast, and they're seeing higher and higher rents into the future. Occupancy rate. So again, this is just another indicator of strong demand for the property itself. We're preparing actual property. We're comparing Okemos submarket. We're also comparing Lansing. You can see the property has had the higher occupancy typically than the submarket or Lansing itself as a market. But one thing that I thought was very compelling is, looking back we're looking back further than a decade. We're looking, really over 12-year period. Occupancy really kind of just has hovered between 96 and almost 100. The only time that it dipped down was this period in 2017. The owners bought the property in 2016. They did a large exterior renovation. They increased the rents quite a bit, almost 20%. That dropped occupancy down to basically 90%. That's the lowest occupancy the property has hit in over the last 12 years. It hit 90%, and look what it did immediately the year after. It shot right back up to 98%. Those rental increases were immediately absorbed, and that wasn't in the high inflation, high rent growth period that we're in right now. And again, still, it's kind of hovered between that 95, 97, 98% range over the last 12 years, giving us a lot of confidence that there's just an incredible amount of demand, and that demand is not going to slow down anytime soon. All right, let's get into actual specific business plan outside of the renovation. Let's look at some of the numbers, or really how we're looking at this from an investment point of view. So reminder, this project is offered through the Gray Fund, and so your returns, the reason we're looking at mostly project level returns, although we do have it broken out also by kind of class of returns in the Gray Fund. But just as a reminder, in the Gray Fund, your return is going to be based on a diversified portfolio that is all going to be supported by the project cash flow from all 7 to 10 properties in the Gray Fund itself. And so just providing just unit returns or kind of LP level returns isn't going to be actual what an investor's returns are going to be, because the returns are going to be a combination of multiple fund assets. So we're looking at mostly project level returns, but we did extrapolate that out. If we flowed through just the fund waterfall just for this property, what that would look like. So and again, I think this highlights the advantage of some of how the Gray Fund is structured, but we're looking just under a 15% IRR, 14.5% IRR project level internal rate of return over a 10-year period. Now I'll show you if we did a 5-year hold, what that would look like. It'd be quite a bit higher. But again, we're looking at a more conservative approach. But if you were a B unit investor in the Gray Fund, you only bought B units, your return actually would be 16.5%. And that's due to the structure of the Gray Fund using a dual class equity structure. If the A units themselves their upside is capped at 10%, and therefore the excess profits roll over to the B units. Now the A units, they're getting a 10% preferred return paid monthly. So if you're focused on cash flow, the A units are a great option. Now, most investors are investing in A units and B units to kind of create a custom and tailored return profile that I mentioned earlier. But, for getting 10% cash on cash, you're getting a little over a 10% IRR in the A units. I mean, you're beating the long-term average of the stock market. But if you really want to get some higher returns, those B units, they're really cranking out a solid return and looking at a 3.7 equity multiple over a 10-year period. Just on our financing assumptions, again, you'll see this is assumed at 55% LTV. That is a very low loan to value. Our going in debt service coverage ratio, how much room do we have to pay the loan? 1.57. Most lenders want it to be like 1.2. So we've got so much room in this deal, a lot of room for safety margin for error. We're assuming a higher interest rate that we'll be hopefully locking in shortly at 4.4%, 60 months of interest only. And it's going to be amortized over actually over 35 years as the agencies have extended their amortization periods. We're assuming a 5.25% exit cap rate. That's about 100 basis points expansion of what we are buying it at. We'll look at some sensitivity analysis to kind of see what the returns would look like at a higher cap rate as well if the market really turns. But again, that's why we're using a 10-year projected hold window. That allows us to pick the ideal time of exit. So if the market does, go on a slump for a little bit, we can wait that out. We've got a high degree of margin for safety, and we can sell it at the most opportune time itself. Now, probably the best way to review this pro forma is for you to request the full Club Meridian property supplemental. Along with the Gray Fund investor presentation, we do very detailed property supplementals on each asset that we purchased, just as detailed as we would if we were just doing a single asset syndication. So I would request that you can request that from myself, again, from William, from Blake, any of the investment associates here at Gray Capital. We'll be happy to walk you through some of these details. But one thing I wanted to mention, because there's a lot of, I guess, this just referring to the speculation in the market right now, and how much speculation are we using on rent growth? Really, not much. So to highlight, and this may be slightly difficult to see, but I want to pay attention to this rent growth line item. In the first year of operations, we're only underwriting that we're going to be raising rents 4.5%. That's just a little bit over the long-term national average of organic rent growth. The reason why it's lower is in our models, we take into account for the time it takes to renovate a unit, how many units are we going to be renovating in a given year, and that takes time. We're also looking at how often units are turning over. So we're not just kind of plugging in like all the rent growth day one, because that's just not reality. Now, most of the rent growth does occur in the second year of operations. Again, we've been renovating units, we've been putting money in, we're raising rents. So it only comes out to about 10%. That's just what the organic market rent growth is right now in Okemos. So an organic rent growth doesn't typically take in the forced appreciation from a value add plan. It leaves us to believe that our underwriting is maybe overly conservative, but I think is probably healthy in this uncertain environment. And that rent growth kind of declines from that as we've, absorbing those market rent increases from the renovation plan and eventually tapering off to below 3% after stabilization, basically at 2.75% rent growth for the remainder of the hold period itself. Let's look at our cash on cash projections over a 10-year period. Again, average cash on cash is about 8.5%. Starting off just below 6%. I'm highly confident we'll be over 6% year one. Again, baking in some conservative rent growth projections. But we'll be at 8% cash on cash by year three and approaching, 10% closer to the end of the hold period. Now, this doesn't, again, we're not taking into account a refinance, which we will most certainly do as soon as it is appropriate, most likely in the second or third year once we force appreciation. One thing I think is very important to point out, again, is the low risk nature of this investment. Looking for an appropriate balance between risk and return. What it would take for us to not be able to pay the mortgage, in worst case scenario. In the first year of operations, which, it's the first year we'll be running the property, it'll be the skinniest year since we haven't necessarily raised rents and increased net operating income. Our break-even occupancy, again, the occupancy level it would take for us to not be able to pay the mortgage would be just under 60%, 58%. Oftentimes you see this range, the break-even occupancy at 75%. But we have to go all the way down to basically 60%. And as the project goes on, that gets as low as, 50%. And again, looking at over a 10-year history of occupancy at the property, it's never dipped below 90. And that's even taking in when they raised rents back in 2016, 2017 by 20%, which we're not even underwriting getting even half of that in a year. But let's look at a whole range of options. Again, predicting the future, essentially a fool's errand, right? So let's look at a variety of cap rates, good, bad, and the ugly. 6.25, which is, about 250 basis points away from where we are today, all the way down to 4.25, which that's where assets are trading, actually even below this. But, if that happens, great. And then also taking into accounting for time, because again, the longer you hold it, the lower the IRR. Our just base case assumption is around a 5.25 cap rate, 10-year hold. And again, so this would be for the B unit sensitivity. For a 10-year hold at a 5.25, it's a 16.5%. Now, if this was only a 5-year hold, we'd be at just under a 22%. Let me turn this whiteboard on again. So again, this is kind of our base case right here at the 16.5. Now, again, if it was a 5-year hold, we'd be closer to this 21.85. But if we sold it, let's say cap rates blew out. The market took a huge turn. We're at 6.25 cap rates. Well, let's say we sold in year 5. We're still getting a 14.72% cap rate. Now, if it's 6%, we're at 16.68. Really, the range in a worst case scenario for between hold periods and a 6.25 cap rate, we're basically between a 15 and a 14, depending on the hold period. That's a pretty decent worst case scenario in my opinion. And again, I don't even like looking at the rosy picture because we would rather under promise and over deliver. But I mean, if we sold this thing in a year from now, I mean, 92% IRR, that's not being remotely contemplated, but that would be the opportunity if we wanted to. Again, that's really being manipulated by the period of time. So we're looking for a longer duration, looking for cash flow. That's just not what we do. We don't just flip properties around like that. But let's say that cap rates remained actually raised a little bit, and essentially remain the same even at a 5-year hold. We're looking at a 30% IRR. So we've purposely chosen a more conservative approach. Other syndicators may just show you this option right here, or they may just show you this 5-year hold period, which are all 20% IRRs. We're showing you kind of I think, a much more conservative outlook than most would. All right, let's talk about the timeline, how you can participate in investing in Club Meridian. Again, this is being offered through the Gray Fund. Project was placed under contract April 8th. We're going to be closing on June 7th. We're going to be issuing a capital call in May, between the second week of May, targeting May 11th. It means you need to have your commitments in for the Gray Fund really in the next week or two in order to make sure you've got a spot and that your capital will be called in full in order to participate. So again, hop on over to just gray.fund in your browser to kind of start the process. You can email myself, Spencer at graycapitalllc.com. You can email William. He's our incredible investment associate, William at graycapitalllc.com, or Blake at graycapitalllc.com, whoever you've been working with to kind of just to get the property supplemental, make your commitment, sign the documents, and get the ball rolling. We're incredibly excited to partner with you. Around May 21st, though, we're going to be calling capital commitments are due. That way we can close on the property on June 7th. Now, one piece that I haven't gotten into yet is that, because you may be saying, let's go back to these sources or assumptions. It's quite a large equity raise, looking at anywhere up to almost $40 million of equity that is going to be required for this acquisition. That would be too large of an allocation for the Gray Fund, because we're trying to keep things diversified, and we don't want any one asset to be over 20% over the overall fund. So what we are, and I'm going to stop sharing here for just a second. So Gray Capital, we've already received a commitment from a large private equity joint venture partner that's committing around $24 million to this project, as well from a family office contributing over $5 million. And then the sponsor team at Gray Capital, we're going to be contributing ourselves $3 million to the project itself. So we already have the vast majority of the equity already committed for this project. And I believe that being able to sign on our joint venture partner that's contributing $24 million, as well as this multifamily office that's contributing another $5 million. These have all been independently underwritten and analyzed by these institutions. And they're incredibly excited, and as we are, to partner with them on this project. So I think that's another indication of the strength of this project. It's attracting quite a bit of interest from institutional sources, but we're allowing you, friends, partners, Gray Capital, members of the Gray Fund to participate along with these institutions to get direct access to this incredible asset. Now, again, this isn't going to be the only asset in the Gray Fund. I think this is a good example of the types of projects that we're pursuing. So if you'd like to continue to be invested in this portfolio that eventually will be 7 to 10 multifamily assets, I would make a commitment, sooner rather than later, so you can secure your spot. Because as interest does increase, we will be closing out the fund as soon as we hit that $100 million mark. And again, we're already going to be raising close to $40 million just for this project itself. So if you have any questions about the Gray Fund, anything at all, please go to gray.fund, reach out to me, Spencer at graycapitalllc.com. We'd love to have the discussion with you, kind of share why we're excited about Club Meridian, as well as some of the other projects that we're pursuing at Gray Capital for the Gray Fund. We've got another project that will be under contract shortly as well, which will do a kind of a deep dive and analysis on as well. But for now, we wanted just to share why we're so excited about the Gray Fund. Again, so gray.fund, or you can make your commitment today at graycapitalllc.com. Again, reach out to any of us at Gray Capital to have a conversation. If you fill out the form at gray.fund, one of us will be in touch with you right away, schedule a meeting, answer any questions, and get you signed up. It's a pretty quick and painless process. You do have to be an accredited investor, but if you're not an accredited investor, that's all right. Hopefully we'll be sooner rather than later, and we'd love to partner with you. All right. I hope you have enjoyed this presentation for the Gray Fund, the first asset under contract. We're incredibly excited. I hope you are too. We're looking forward to partnering with you on this asset as well as all the assets in the Gray Fund. If you're ever in Indianapolis, please feel free to reach out with us. We'd love for you to come by the office, meet you in person. Because we love meeting our partners, going out, being able to have dinner, or having a drink. So just get in touch with us whenever you can. Again, if you have any questions, pop on over to gray.fund. You can email myself, Spencer at graycapitalllc.com. That really concludes this latest webinar for the Gray Fund. My name is Spencer Gray, President and CEO of Gray Capital. I'm happy to answer any questions if there are any. And if not, again, I thank you for attending, and I'll see you on the next webinar. All right, well, it looks like no questions, no worries. Again, feel free to reach out to Spencer at graycapitalllc.com or William at graycapitalllc.com. And then once again, just hop on over to gray.fund to get the process started. All right. Hope everyone has a great Saturday. I'm going to go pick up my two girls. We're going to go to soccer practice, have some fun. I hope you have a nice Saturday and weekend as well. Hopefully this weather gets a little bit warmer, at least here in the Midwest. It's like 40 degrees right now. Want it to be a little bit warmer, but spring's right around the corner. So, all right, everyone. Hope you have a great day, great weekend, great next week. And let's go make some smart investing decisions, and looking forward to partner with you on the Gray Fund. Thank you.